G'day guys, welcome back to the Devon Too Good Investing channel. Today in this video, we're going to be analyzing PayPal stock and we're going to be trying to value the company to see what we might want to pay for it using some reasonable and conservative assumptions. So before we get into it guys, make sure you like this video and subscribe to my channel. For the valuation of PayPal stock today, we're going to use what's called a discounted free cash flow model, and we're going to try to estimate free cash flows that PayPal are going to produce over the next 5 years out into year 2026. So we're going to need a few different parameters in order to make this valuation work. So we're going to have to come up with a set of growth rates that we think PayPal can grow their free cash flow at. We're going to have to come up with a starting free cash flow value. And we're also going to have to come up with a terminal multiple. This is the multiple that PayPal will be trading at in 5 years. We're going to enter in our required rate of return. We're going to enter in the shares outstanding, and also we're going to account for any debt and cash on the balance sheet. So first of all, we're going to go and we're going to think about what kind of growth rates we think PayPal can grow at. And one of the places we can look is, what is the overall payment market, the overall global digital payment market? What do we think it can grow over the next, say, 5 years? Well, this report here gives us a growth rate of 20.5% over the next 8 years out to 2030. So analysts tend to believe that the digital payment market can grow at about 20% per year going into the future. And if we jump onto Ticker, we can actually see analyst estimates going over the next 5 years. And you can see that analysts believe that PayPal is actually going to grow their revenues at about the same pace as the report we just looked at there. And that's going to be growing at a CAGR of about 20.4% for revenues. But if we scroll down and we have a look at free cash flow, analysts actually believe that over the next 5 years, they're going to grow free cash flow at about 23% per year, which in my opinion is probably a bit too optimistic. Especially if you look here, they're estimating free cash flow of 6.3 billion for this year, analysts are, whereas the company's management, they've came out and they're aiming for 6 billion. So we'll see about that, and we'll see on the next earnings call whether management reiterate their guidance or if they bring it down. So for me, I'm more comfortable of using growth rates between 8 to 16%. I think 8 if you're very bearish, 16 if you're more bullish, and then maybe 12% if you're sort of in the middle there. I do think, the 20% growth rate or the 23% growth rate that analysts are sort of predicting, I think that is a bit too optimistic, and I like to be conservative and realistic with my assumptions. So the next one that we're going to think about is the starting free cash flow, and this was simply taken off the cash flow statement. So it was the operating free cash flow minus the capital expenditures. And then for here, you probably noticed that all these 2022 free cash flow values are the same. Yeah, it's the same because I just used management's free cash flow guidance for 2022, and then based off that, I've grown it out using our growth rates over here. So the next value we need to consider is the terminal multiple. So a way we can have a look at that is by looking at what multiple PayPal has traded at in the past. So I've got a chart here that goes all the way back to 2015, and you can see that the mean PE ratio that PayPal has traded at is at 53, and honestly I don't feel comfortable using the mean here. Honestly, when I'm doing discounted cash flow valuations, I very rarely like to put high multiples in. We can see at the moment they are trading at a 24.44 PE ratio, and look, I think for this model, you can either use a 20, I think 20 is okay, but if you want to be even more conservative, you could use a 15. And if you use a 15, it just means your returns are you got a greater margin of safety baked into your valuation. And you might be asking me, why am I using PE? Aren't we talking about free cash flow here? Well, I'll show you why I did that. So if I click on the free cash flow ratio here, and I back out the PE ratio, and we make it over a long period of time, you can see that this graph is very choppy. So I thought that the data from the PE ratio graph was a bit more useful, and I think it represented the sort of previous multiple that the company's been trading at a bit better. So if we go back to here and we put in our terminal multiple of 15, required rate of return, that's 22%. That's what I want to make as a return on my investment. That's the hurdle rate I'm aiming for. Maybe you might want 10% or 15%. Maybe you want 30%. This is up to you, and this is personal. But I think by incorporating a 22% return, even if I'm a little bit wrong with my valuation, I should still make a good return. And then shares outstanding. This was taken straight from the Q4 report. So this is taken straight out of there. And then net cash, I'll show you how I got that. So we got just under 6.5 billion. So the way I got that was, we got the total cash and short-term investments here. So that's 9.5. And then we added in the long-term investments here. So PayPal do have some stock market holdings, as well as some longer-term bonds that are going to be maturing over the next sort of more than 1 year out. So I added that to the $9.5 billion. And then PayPal also have some debt. So the debt is 9.8 billion. So once you minus the total net cash from the debt, you get the just under $6.5 billion there. And if we factor all these in, we're getting buy prices for PayPal at between $63 and $80. Obviously $80 if you're more confident on the growth. If you think they can grow 16%, $80 is your sweet point. If you're not so confident, you think, hey, they might only grow at 8%, well, $63 is your target. If you're not too concerned about making that 22% per year, maybe you're after 15. That would put anywhere between $84 and $107 as your target. Let's say you want that 22% return, but you want to be even more conservative, and you're like, whoa, like 20, I never do terminal multiples at 20. Maybe I feel more comfortable with 15. Well, your new buy price is between $53 and $66. It really just depends on what you believe the best assumptions for you are and what you think is going to play out. Who knows? Maybe you're like, I agree with the analysts, and you think free cash flow over the next 5 years is going to grow at 23%. Well, hey, with a terminal multiple of 15, they'll give you a buy price down here of just under $80. If they're going to grow at 23% per year, their terminal multiple will likely be higher. So look, maybe you're looking at 97. So these are all different possibilities that might play out. I can't tell you, exactly which one's going to play out, because honestly, I can't be sure of it. It's better to be approximately right than exactly wrong. So I think the best way to go is be conservative. So I don't think that PayPal will grow at 23%. I think they'll grow somewhere between 8 and 16%. And look, I can't predict the terminal multiple. Maybe it's 15, maybe it's 20. It's just got to be the risk you're willing to take. So look, guys, I've pretty much taken you through the valuation here. Hope you enjoyed the video. Make sure you subscribe to my channel and like this video so more people will get to see it. And have a good one.